Did you know the dot-com bubble wiped out $5 trillion in market value? Now brace yourself because every time a market bubble forms, it's us, the people, pulling the strings. Yes, you heard that right. Our emotions and decisions are the architects of these financial phenomenons. Let's break it down. Humans have some quirky tendencies when it comes to investing. Ever heard of FOMO, or the fear of missing out? It's more than just social media jargon. In the market world, FOMO skyrockets asset prices as investors rush in, hoping to catch a golden wave. A cycle begins where rising prices fuel more demand, feeding the bubble even further. But wait, it gets more fascinating. Confirmation bias plays its role beautifully. We're all prone to seeking information that solely strengthens our beliefs. If we think a stock's a winner, we'll find the stories that tell us, buy more. Now mix that with herding behavior, the classic everyone's doing it, so I should too. It's like a wild dance driving prices beyond their true value, inflating the bubble to a breaking point. And when it pops, well, it's a different story altogether. Stay with me, there's a lot more to explore. So, what happens when the bubble finally bursts? It's like someone turns the party lights on, and suddenly, everyone sees the mess. Panic sets in, and the same frantic buying energy flips into a selling frenzy. Investors rush to cut their losses, and prices plummet, all because fear and doubt take the spotlight. But there's more beneath the surface of these cycles. Let's look at the role of narratives. Every bubble has its story. In the dot-com days, it was the promise of a tech-driven future where every online company would soar. Recently, it was cryptocurrencies, with the dream of decentralized riches. These narratives captivate our imaginations, often blurring the line between reality and hype. Yet, amid this chaos, there's a silver lining. Economic historians and savvy investors know that bubbles, though destructive, can drive innovation and progress. Think of the railroads, automobiles, even the internet itself. Each had its bubble, leaving behind infrastructure that reshaped industries. Here's a thought. Cycles are inevitable, but understanding them can be empowering. Recognizing the signs, studying the narratives, and maintaining a balanced perspective helps us navigate these tumultuous waters. And as we anticipate the next bubble, remember, there's always a lesson waiting to be learned. Stick around to find out how you can spot these bubbles before they burst. Let's dive into how exactly to spot a bubble as it's forming, so you're not caught off guard when the tide turns. Here's a key indicator: rapid price escalation without corresponding growth in underlying value. Remember, when stocks or assets are soaring at an unsustainable pace, it's often driven by hype rather than fundamentals. Listen closely to the chatter. When you notice more conversations focusing on getting rich quick or hearing tales of seemingly effortless gains, that's a red flag. This irrational exuberance can be intoxicating, but it often precedes a downturn. It's crucial to ask, what's the actual value here? Real growth stems from innovation, profitability, and sustainable advantages, not wishful thinking. Also, keep an eye on market liquidity. During bubbles, liquidity often tightens as prices fly high. This may sound jargon-heavy, but it simply means fewer buyers are available at those inflated prices, setting the stage for a crash once selling begins. Here's the interesting part. Psychology plays a massive role. When investors start talking like "this time is different," beware. It's a classic sign of a bubble mindset, ignoring historical lessons. Equipped with this knowledge, you can maneuver through the turbulence with foresight, making informed decisions rather than emotional ones. And if you think that's all there is to it, think again. We've only scratched the surface. Next up, we uncover what the aftermath of a bubble looks like and how to leverage it to your advantage. Stay tuned. Once a bubble bursts, it leaves behind a landscape filled with valuable opportunities and harsh lessons. But what happens in the aftermath, and how can you turn it to your advantage? Let's talk recovery and strategy. Initially, chaos reigns supreme. Prices nosedive, panic selling ensues, and pessimism pervades the market atmosphere. For seasoned investors, however, this is where things get interesting. Post-bubble environments tend to flush out weaker players, leaving behind robust assets and companies that can be undervalued jewels amidst the rubble. Patience is your ally here. As the dust settles, markets often overcorrect in the downturn. This means prices drop below true value, offering a chance to pick up strong assets at a bargain. Doing thorough research, focusing on companies with solid fundamentals, and avoiding the lure of speculative plays are key to building a resilient portfolio. Moreover, these periods often spur innovation. Picture the aftermath of the tech bubble. Companies refined their models and gave birth to the giants dominating today's digital landscape. So, keep an eye out for emerging sectors and technologies that might just change the game. Shifting your mindset from fear to opportunity during these times is crucial. Recognize that every bubble is a cycle of excess that, when corrected, can provide fertile ground for growth. So, as you brace for future economic waves, remember, knowledge and strategy are your life rafts. Now, are you ready to seize the opportunity the next time the bubble inflates? Now, let's switch gears to the personal strategies you can employ for managing risk in your own financial endeavors. Think of it as preparing your financial storm shelter. First, diversification is a cornerstone. While it's tempting to chase the next big thing, spreading your investments across different asset classes can shield against severe losses when a bubble bursts. Stocks, bonds, real estate, and even alternative investments like commodities can provide a balanced mix. Next, embrace the power of mindfulness in investing. In the face of flashy headlines and market hysteria, staying calm and grounded helps you think clearly. Regularly remind yourself of your long-term objectives and financial goals. This helps keep emotional decisions at bay during volatile times. Having an exit strategy is also essential. Before diving into an investment, it's wise to set clear benchmarks and limits. Decide in advance at what point you'll sell if things aren't going as planned, and equally importantly, when to take profits while they're on the table. Finally, continual learning and adaptation are your best tools in an ever-evolving market landscape. Engage with financial news, listen to expert analyses, and most importantly, learn from past cycles. They offer a textbook in real-life algebra of market movements. Ultimately, it's not about predicting every bubble, but about positioning yourself to withstand whatever comes your way. By arming yourself with insights and strategies, you're not just surviving the cycle, you're turning it into a stepping stone toward a more secure financial future. Feeling empowered? You should be. Let's wrap everything up by remembering that market bubbles are as much psychological phenomena as they are financial ones. By understanding the cycle, how it inflates and inevitably bursts, we can equip ourselves with the tools to navigate these turbulent waters with confidence and resiliency. It's about seeing beyond the frenzy and making informed decisions. Now, if you're ready to take your financial journey to the next level, make sure to subscribe to our channel and hit that notification bell. Why? Because we're dedicated to bringing you the insights and strategies that will help you stay ahead of the game. Join our community today and turn knowledge into power. Let's build a smarter investment future together.